Good evening. I'm Meena, Mr. of Shivdev, and it is an honor and a privilege to welcome you, our brave health professionals, as well as all the individuals from the various disciplines. Thank you all for registering, and a heartfelt thank you to our sponsor, Innovative Medical Supplies. The COVID-19 pandemic has had dire financial consequences for the whole world. South Africa has not been spared. The South African government has allocated in excess of 500 billion to both business owners and its employees, as well as South Africans in general, to fight the pandemic. This is not going to be enough, as there's no end in sight to finding a cure for the virus. This evening, Shivdev Academy presents Professor Dilip Garach to give a talk on financial tips in managing finances during COVID-19. Prof. Dilip Garach, a chartered accountant and a certified financial planner with a master's degree in commerce taxation. Prof is currently in the final stages of developing a software that will revolutionize the financial and the fiduciary services industry. He has extensive credentials, to mention a few. He's an economic and a financial commentator. He's a former professor in tax at KwaZulu-Natal. He's a CEO of Garach Corporation, a multi-disciplinary financial and a fiduciary consultancy office. He's a financial advisor on national radio. He's a former board member of SARS, served on the executive committee of SARS. He's a Minister of Finance Accountancy Review Commission member, advisor to Ministers of Finance, member of the Income Tax Special Court, director of commercial boards, television appearances on SABC, ENCA, and BBC Africa News. He specializes in tax, business, finance, the economy, and entrepreneurship. So this is a pre-recording with a question-answer session with Prof at the end of the talk. So sit back, relax, grab a drink and a snack, and enjoy a CPD webinar in the comfort of your home. Financial Freedom is available to those who learn about it and work for it, by Robert Kiyosaki. Thank you.
Wire forming technology capable of forming wires with micron-level precision. Resin coating technology capable of forming an ultra-thin film coating. Torque technology capable of providing a highly accurate rotational response.
Good evening, ladies and gentlemen. Just some introductory remarks before we commence the webinar. The webinar is much broader than just managing your finances during COVID. The hardships that have been created by COVID must have made you sit back and notice that there is something that one has to do. So you must have thought about, how do I plan my finances going forward? Have I structured my business properly? Have I taken maximum advantage of all the tax planning opportunities? Have I structured my assets properly? Have I drawn up a proper will? Is my wealth being properly managed? These are important questions that you have to consider, and it's important that we actually talk about these during our webinar. This particular webinar will be beneficial to professionals as well as business people, and as well as salaried people, and those in particular in the high income tax brackets. There are lighter moments in this webinar where we take a break and we have a stress break. I'm aware there are people from other countries that will be zooming in. As far as that is concerned, the tax laws are the tax laws that apply to South Africa. So if we go into the webinar itself, the content, we're going to have a look at the impact of COVID on the economy, COVID sickness benefit claims that one can make, SARS and tax planning, the use of trusts in wealth planning, wills and deceased estates, private wealth management. COVID has been an unprecedented event. It is a pandemic. It has affected the whole world. At present, there is no cure, and no cure is expected in the foreseeable future. In South Africa, this particular pandemic is being controlled by the president, and the president is going to ride us through the crisis. He is certainly on a very tight rope. We know on the one hand, if he opens the economy and allows people to go back to work, there will be food on the table and people will not die of hunger. But on the other hand, as he opens this economy, people will start to go back to work and people will be mixing, and as a result, more people will be infected. Now, this is what is going to create a problem. More people will fall sick, and the real question is, do we have the health infrastructure in South Africa to be able to cope with this virus? Now, certainly the Minister of Health has indicated that he expects about 60% of the population to be infected, which means about 35 million people will be infected by this particular virus. Now, if 5% of these 35 million people were to now go to hospital and be in ICU, which means that we will require facilities for 2 million people, do we have the infrastructure? So it's a very tough balancing act. I don't envy the president at all, but it's something that we have to live with. There has been a serious problem in Australia, in Melbourne. Melbourne has now been plunged back into a lockdown, a 6-week sentence for them, and which started last week, and that certainly doesn't look good at all. Now, the impact of COVID on the global economy as well as the South African economy, economies generally have collapsed. Businesses, big and small, have become unsustainable. Governments are scrambling to borrow money as we know it. Bankruptcies are inevitable. Unemployment will rise. The thing is, we need to protect lives. Are we worrying about preserving the livelihood of people? As far as unemployment is concerned, we certainly have an unemployment rate in South Africa of 30%. Over the next 1 year, we expect that rate to double. So roughly 60% of the people in our country who are employable will become unemployed. Also, we have many small and medium kind of businesses, and these will have some serious issues. So the real casualties that we're going to be looking at, people are going to be falling sick, and can they claim from the insurance? So this is the sickness benefit claims that one can make. We have to just briefly look at some terminology. The waiting period. There are different waiting periods with different insurance companies. Some have 7 days, others have 30 days. We must understand the definition of quarantine as well as isolation periods, and that is at this point in time known to be 14 days, and that could even be reduced. We have the National Institute of Communicable Diseases, which has defined who is a person under investigation, called PUI in short, and that is a potential COVID case. So persons under investigation who are asked to be quarantined, these are the people who come into contact with COVID positive people. It's not necessary to test positive, but you can most definitely lodge a claim for sickness benefits if your insurance company permits you to a maximum period of 14 days. Persons who test positive, you can claim for the period that you're not well, plus the isolation period. Persons display no symptoms and are asked to work from home, they obviously cannot claim at all. People who have influenza kind of symptoms, which we are getting now, these people most definitely can claim for the period of their sickness. The second casualty we have to look at is businesses. Certainly over the next 1 year, many businesses will be will have some serious problems and they will need to be rescued. This is a fairly new concept in South Africa. It's known as business rescue. It's supposed to identify businesses that are in distress, and generally what happens is that the law permits us to set up a mechanism where a business rescue practitioner gets appointed and he then takes over. And what he in actual fact does, he assesses the ability of the business to recover from the stress itself, or from the distress, if I may say. And the role of the business rescue practitioner then becomes important within the business. So this is something that you may have to consider as one moves forward. The other area of casualty most definitely are government employees. Government employees are sitting in a real quandary, especially many of them who are doctors, perhaps lawyers, educators, who are afraid to really go back and really be in a public position purely because they could become infected. So that's seriously one issue that they're considering. And the other problem that we certainly have is the government employees pension fund. So these government employees do belong to the government employees pension fund. And what is happening as far as that is concerned is that the government, because it had spent over 500 billion so far as far as COVID is concerned, it is going to be looking for money. And it has already identified these pension funds, and laws are going to get passed whereby they would be allowed to dip into pension funds. And the first particular fund that they will dip into is the one that is called the Government Employees Pension Fund. And on that basis, many government employees are considering the options. They can either retire or they can resign from the GEPF. If they resign from the fund, they can take all their money out. If they retire, they have to leave the money in there. Their concerns are, as time goes on, there may not be enough money within the fund, and they are rightfully justified in believing that perhaps there could be some issues within the government employees pension fund as they move forward. So, but before they make a decision as to whether they should retire or resign, there's a multitude of factors that you need to consider. The condition of your health, do you have a spouse, do you have dependents? So all of that information needs to be digested, and therefore it's important for you to seek advice before you make a decision whether to retire or to resign from your retirement fund. Just to move on, it most definitely the government has been borrowing money. It's borrowed over 500 billion as we know it. That's the one aspect. It has taken some of its internal funds, but it is continuing to borrow. So there's a large amount of money it has borrowed, and it needs to repay this money sometime in the future. So which means that it's going to be taxing times for the wealthy people of our country. Undoubtedly, we've already been told that the government wants to introduce a wealth tax. We'll talk about that, but it's about start paying taxes again, more taxes, and more again. Certainly, when it comes to wealthy people who live a lifestyle which is pretty lavish, what normally happens is that SARS have been identifying such taxpayers and sending out lifestyle questionnaires just to make sure that the income that they declared to SARS matches their lifestyle and their assets. So this is something that you need to consider. Certainly as a high net worth person, you can expect these questionnaires to be passed over to you, and you need to fill them in a way to ensure that you don't end up having on the wrong side of SARS. Now, typically the hunting grounds for SARS, especially with high net worth people, are the cars that they drive and the asset and lifestyle reconciliation that is performed. In other words, they identify the lifestyle that you lead, they match it with the income and have a look at your assets. And once when they've established that you have not correctly disclosed your income, then what they do is that they issue you with an assessment, and then you end up having to pay the taxes, and there could be penalties that could apply. So this is what they call understatement of penalties. It's called USP from their perspective. The penalty can be from 0 to 200% depending upon your behavior. So your behavior can vary from voluntary disclosure before an audit is performed to say that you haven't disclosed all your income and you're coming forward, to the point where there's intentional tax evasion, where clearly the 200% penalty will be levied. So you have to ensure that the that you do come forward if you haven't disclosed all your income to be able to show SARS that there has been an omission on your part, and you are quite willing to pay the extra tax. So penalty will not be imposed. If a penalty has been imposed, or if you have a mountain of tax debt, can you compromise your tax debt with SARS? Yes, it is possible to compromise your tax debt. You have to do a proper motivation. You must show a good cause that going forward, the fact that you employ so many people, and that if you were to shut down because SARS is applying the pressure on you to pay your debt, that could cause a problem, that you may have to close your business down and people will become unemployed. So you've got to show a good motivation, show a good cause, and that will be possible. And it's important that you seek professional advice when you do this. Wealth tax, well, there's already talk about a wealth tax, but don't we have a wealth tax in this country? There are several forms of wealth taxes in this country that we already have. There's the high net worth people pay almost half of the income that they earn in the form of tax. There's dividend tax, you pay 20%. There's capital gains tax that you pay as high as 18% at the maximum level. There's transfer duty on property transactions in this country. Did you know that transfer duty on property transactions is the highest in the world? So we certainly pay a lot of wealth tax. So I'm not sure what is being referred to is that the government is now talking about introducing a new wealth tax. But there is a thing about tax morality. In other words, taxpayers ask this legitimate question. For the tax that I pay in this country, what do I get in return? Do I get free schooling for my children? Do I get a pension? Do I get a free medical aid? You have to do all this on your own, which really means it's an additional form of tax that you are paying. So is that not a form of tax? Well, perhaps an unfair question to ask in a country like ours if you look at our historical past. But on the other hand, if you have a look at the unauthorized, inefficient, wasteful and fraudulent expenditure by government itself, then you have every right to ask the question, what are you doing with my money? So certainly it leads one in believing that you have to plan your affairs so that you pay the least amount of tax. So that is what tax planning is all about, and it is possible, it is perfectly legitimate, and you are entitled to pay the least amount of tax, provided you plan legitimately. So there's a big difference between tax avoidance and tax evasion. Certainly one is legal, tax evasion is certainly not legal. We're not here to show you how to pay no taxes, because certainly if you earn an income, there is a moral obligation for you to contribute to the fiscus of the country so that it can uplift the people of the country. So it's important that you do pay taxes. But on the other hand, it is possible with tax planning, which is a legitimate way of doing things, you can possibly split your income. So how do you split your income? In South Africa, we have a progressive tax system. The higher the income, the higher the level of tax. So if I take 1 million rand of income and pass it on to one person, the tax that they will pay is 325,000 for the year. If I take the same million rand of income for the year, and if I split it between two people in the family, let's say the husband and wife, if we can enter them into a partnership, then the total tax that the both will pay on the million rand will be 250,000. So there's already a saving of 75,000 rand. If I can split that 4 ways, perhaps with the children who can help in the business, if I give each person 250,000, the total tax the family will pay is 200,000. So there's a difference of 125,000 rand per year. And as you can see, just by splitting your income, you can achieve tax savings. We'll talk about this a bit later when we look at trusts, but certainly splitting of income, you can achieve a tax saving. How about wealthy people in this country who generally end up not trying to receive a salary, but what they actually do is that they invest in assets. So if you take a salary at the highest level, which is 1.5 million, you start paying tax at the rate of 45 cents in the rand. So that's 45%. But on the other hand, if you, for example, buy shares on the stock market, and if you receive a dividend, you pay no tax on the dividend, and only when you actually sell your asset, you will pay a capital gain at the maximum rate of 18%. So there's a difference between the salary and in respect of income that you earn as opposed to a capital gain in assets that you sell. And that's what we call a tax arbitrage. You can see the difference. One is 45%, the other is 18%. So it's about receiving a salary versus investing in assets. How about setting up corporate entities? Corporate entities pay less tax. Certainly, let us assume that you are a medical practitioner and you practice as a sole practitioner. On income greater than 1.5 million, you will pay tax at the rate of 45%. On the other hand, if you incorporate your practice and you then decide to take your salary from the practice and you let the rest of the profits be taxed within the incorporated practice, you'll pay tax at the rate of 28%. So again, you see a tax arbitrage. Of course, there are dividends tax to pay in the company at some later date. However, if you plan your affairs, you certainly achieve quite a lot of tax savings. Investing in the retirement fund is another very good way of ensuring that you're paying the least amount of tax. So typically, if you're on your highest tax bracket and you are now paying tax at the rate of 45%, then for every rand you invest in your retirement fund, you are paying 55 cents, and SARS is helping you to pay the other 45 cents. Because what then happens is that the full 1 rand gets credited to your retirement fund. Otherwise, if you don't have the retirement fund, you'll pay 45 cents in tax and you lose it to the state. But what is important and what people fail to realize, that you must manage your retirement funds. You must watch the fund performance on an annual basis, and you need to do that. There's obviously a restriction on the maximum amount that you can collect, that you can invest in a retirement fund, and that is in terms of a formula. Now, this is a stress breaker that I was referring to, an unfortunate spelling mistake in an SMS to his wife by a man visiting Cape Town for a conference, having a wonderful time, wish you a her, should have been here. Sometimes you press these buttons too quickly and this is what happens. Now, it's important from a structuring point of view and to look at future generations and to look at your family and all the wealth that you create, that you don't lose it. It's important that you set up formal structures to ensure that your assets are properly placed in these kind of entities. And you also have to ensure that you have a properly drawn will. So it's all about setting up a trust, and you form a trust, and you generally put your assets that grow in value over time. It could be property, it could be businesses, it could be shares for the benefit of your beneficiaries. So you put that in place, and generally that does not form part of your estate, and we'll talk about that a little later, but certainly you need to draw up a proper will. And if you draw up a will similar to this one that I have here, you're obviously not doing yourself any favor. And if you can read that, I, being of unsound mind, hereby bequeath 40% of my estate to the taxman. You don't want to do that. So certainly from an asset structuring point of view, it's all about setting up trust. Do you have trust? We often ask the question, do you want to set up a trust? Yes, no. Often people are not sure. People who already have set up trust, they've never used it for years. They don't really know how to use it. They don't really know what to do. Many of them have set up these trusts and want to close them down because they don't have any assets in them. They set them up with no real reason. That's also something that you need to consider. So what is important for you to understand, that trusts are generally vehicles where you enjoy asset protection. So your prime purpose of setting up the trust is to protect the assets that you are now acquiring over and during your lifetime. There are different and complicated structures in trust. You could have a family trust, you could have a property trust, you could have a shared trust. All of these are different kinds of trust. They can get very complicated, but you can also have a very simple trust. However, just to point out, the trusts have many benefits, and some of these benefits are listed here. Certainly, you can save estate duty, so that's what we call estate pegging, starting from 12 o'clock. You can avoid paying tax using a trust, so that's what we call tax planning. The other things that, and these two are certainly I'm going to cover in the next two slides. You can certainly protect your assets, as I indicated. There can be succession planning as you go down generation upon generation, so trust can last for many generations. If there are minor children, you need to protect the interest, and you do that through trust. There can be continuity as far as trusts are concerned, because a trust never dies. And also, upon your death, you achieve lots of savings if you have a trust. You don't, because the trust never dies, the assets remain in the trust, so there's no capital gains tax to pay, there's no transfer duty to pay, there's no executive's fees because it does not form part of your estate, and there are many other benefits that you can enjoy. So now typically, let me explain the estate planning, which has some huge benefits. So typically, if I wanted to buy an asset, a property, let us assume the property is going to cost me, it's a building, it's going to cost me 10 million, and I buy it in my personal name. So I buy it in my personal name and I die 10 years later. So a property gets valued in my estate for estate duty purposes, and let's say that it's in a very good area and it has substantially increased in value. So it increases from 10 million to 40 million. So clearly, when I die, if I have to bring that property into my estate because I bought it in my name, I will end up paying estate duty and capital gains tax in excess of 10 million rand. On the other hand, if I buy the very same property in the name of a trust, and 10 years later I die, that property is not brought into my estate because it doesn't belong to me. I may be a beneficiary of my trust, but it's certainly not my property, and therefore I've saved myself well over 10 million rand just on the one property transaction. From a tax point of view, yes, you can. If I take the very same building, if I had the building in my personal name and I earned an income of 375,000 rand for the year, at 45 cents in the rand, I will pay tax of 170,000 rand. On the other hand, provided the circumstances permit me, I have 5 beneficiaries, all are minor children. I then split that income amongst the 5 beneficiaries. They each get 75,000 rand, and they are below the tax threshold, they pay no tax. So certainly you can achieve tax savings by using trusts. But I think what is important is that trusts are most definitely something that you have, there's a lot of administration involved, and your trust must be legitimate because you fail to perform the necessary administrative matters that trusts require. In South Africa, there are well over, in terms of a recent survey, there are well over 350,000 trusts, of which less than 100,000 are compliant. Now, that is quite important for you to remember, because if you have a trust, you have to be compliant. And what do I mean by compliant? You must have trustees meeting, the trust must have a bank account. Those are important things that you have to do as far as trusts are concerned. And if you're not doing it, then you are not compliant. And SARS will most definitely come after you. There has been a provision in tax law which was introduced in 2017, which to some extent has put the brakes on trusts, which help to avoid taxes. Obviously, that's one of the things that it does. But there are ways to circumvent Section 7C. You can rearrange your affairs, repay loans, make donations. It's all about planning. If you know how to do your planning well, you can avoid Section 7C. Just another stress breaker, the meaning of complete and finished. When you marry the right woman, you are complete. When you marry the wrong woman, you are finished. And when the right one catches you with the wrong one, then you are completely finished. Wills and estates. Your will is your destiny. The Ambani brothers of India, you may have heard of this family, the poor rich family. The 2 brothers, Mukesh as well as Anil Ambani, you see them there. Mukesh, you may know, he is the person who owns, those of you who follow IPL cricket, he owns Mumbai Indians, the cricket team Mumbai Indians. But this is a family, one of the richest in the world. It was involved, it is involved in business of petroleum and telecommunications, Reliance. Remember, it runs a telecommunication industry in India, which is over 1 billion cell phones. And certainly this particular family, the business, the father was the founder of the business. He just made a little mistake. He died without a will. And the disparity in wealth between these 2 brothers is unbelievable. So therefore, it's so important from a winding up of your estate point of view, for it to run smooth, quick, and effective. You need, firstly, you must have a will. And secondly, you have to have the right professional people, a lawyer, an accountant, a financial planner, a tax advisor, and a valuator, all sitting together to be able to ensure that your will is properly drawn and that your estate will be properly administered. Now, what do I mean by a poor rich family. You have Mukesh Ambani, who is meant to be one of the richest people in the world. He certainly stands in to be to one of the top 20 people. At one time, he was the richest person in the world. And you have Anil Ambani on the other hand, who just recently, a couple of months ago, has declared himself as though he has no assets whatsoever. So in other words, his assets are zero. Now, how could this happen in a family where the father built the wealth? So what I'm going to do is I'm going to show you a video of Mukesh Ambani, and you would appreciate how what his wealth is all about.
The most expensive home on the planet. In the inner city of Mumbai, India, not far from the poverty-stricken slums, on the renowned Altamont Road, stands Antilia, the most expensive home ever created. This home ascends 27 stories, stretching 568 feet high, granting the massive structure with prime views of the Arabian Sea. In technical terms, the home is the second most expensive residential property in the world, considering Buckingham Palace is worth around $5 billion US. However, Buckingham Palace is considered a crown property, whereas Antilia is a private residence. And the most expensive private residential property at that, with some pricing estimates as high as $2 billion. Even still, any list in which a residence is preceded by Buckingham Palace pretty much guarantees that place is going to be over-the-top luxurious and is likely a house I'd love to move into. In this video, I'll take you on a virtual, informative tour of this ostentatious estate while engaging all of 2 of your senses. In this massive home, there are several ceilings that are double or triple heighted, so the 27-floored skyscraper looks more like a 50 or 60-floored building. Can you imagine only being as tall as an ordinary 27-floor building? Laughable. On some of the lower floors, there is a multi-level car lot that can hold 168 vehicles, including Mukesh's precious RS5 Crore Maybach, a car for very important people. Somewhere in that car lot is also a car service station. But if cars aren't your style, don't worry. The home also has 3 helipads placed on the roof. Few things say billionaire like more than one helipad on the roof. Both the private car lot and helipads are violations of residential bylaws in Mumbai, but from what we can tell, no one has forced the billionaire's hand to make any changes. Above the car lot, you'll find an extravagant lobby composed of 9 elevators. Further up is a 2-story recreation center with a lap pool, a gym, a juice bar, a dance studio, and a yoga studio. While the 400,000 square foot building is home to just 6, it's also meant to make room for a staff of 600 cooks, cleaners, and security personnel. So that makes the size of the mansion less excessive, right? I double-checked that stat, by the way, and I can confirm 100 staff per family member. The owner of the $2 billion home is Mukesh Ambani, a petroleum titan, chairman of Reliance Industries and, surprise, surprise, the richest man in India. Mukesh is responsible for 1/5 of India's exports, which is absolutely outrageous considering India makes up for 1/3 of the Earth's population. Mukesh's father created a business that turned into the world's biggest producer of polyester fibers and yarns. Mukesh multiplied his inheritance many times over to become one of the richest men in all of Asia. For years, Mukesh was a member of the top 10 richest people in the world. And during one surge in India's stock market in 2007, he was believed to be the richest man on the planet. But as of recently, he sits comfortably at the 20th spot. Mukesh is worth $40.1 billion and is 61 years old. Unlike most families worth billions, the Ambani family owns just the one home as opposed to the expected several around the globe. Initially, the family shared a house with Mukesh's mother and brothers. But after Mukesh's father passed away of a stroke, he decided to break the bank on the 400,000 square foot home.
You can see certainly the wealth there. Makes you think, doesn't it? Do you have a will? Is it valid? Is it updated? Is it personalized? These are important questions that you have to consider. So in other words, in family wealth, it's important to realize that family wealth is created over generations. Paying taxes, unfortunately, amongst wealthy people is a harsh reality. You should consider the following. Are assets structured in the appropriate entity? Are your tax affairs in order? Do you have a properly managed family trust? Do you have a properly structured will? Are your beneficiaries properly stated in your insurance policies and investment policies as well? Does your will, family trust, and insurance policies and personal assets all tie up? There are no loose ends. I know how important that is. The administration of deceased estates, having wound up estates for well over 30 years, we often find that we've come across situations in practice where there's no valid will. There are missing documents, the ID, marriage certificates, title deeds, would take years to find. Financial information is not up to date. Balance sheets have not been drawn up for years. Tax returns have not been submitted. Complicated business interests, no estate planning. Cash falls within the estate itself to cover expenses and liabilities. There's no insurance policies that cover this, and as a result, the estate just lies in limbo for generations. Now, further to that is that from an estate point of view, one finds that when one winds up estates, there are various statutes or various laws that apply to estates. There's the Wills Act, the Estate Duty Act, the Administration of Estates Act, the Law of Interstate Succession, the Income Tax Act, the Pension Fund Act, the Company and Close Corporation Act, the Divorce Act, the Matrimonial Property Act, the Trust Property Control Act, the Civil Union Act, the Long-Term Insurance Act, the Maintenance of Surviving Spouses Act. All of these acts are important to winding up estates, and generally you would find that people, lawyers, accountants, tax advisors, insurance brokers, valuators have knowledge, but only in respect of their own disciplines, and they're unable to put all this knowledge together. So it's so important that you get these group of individuals that can work together to make sure that if you're a high net worth person, that your estate is properly managed and properly administered. It also makes sense for you to consider having a smart file, which is generally something that you can create on your own, an electronic key to an easy and stress-free life. All your important documents electronically stored, your family ID documents, marriage contracts, company documents, trust documents, your wills, your trusts, etc., etc. Your life highlights in a questionnaire, all your planning to be done, your tax, your financial planning, your retirement, your estate planning, and so on, your succession planning. Your business winning formula to be properly documented so that families, as they move on, they can use that. File to be reviewed annually. The ideal situation is if you have created such a file, you should get it reviewed annually and updated. The location of the file is important. It has to be kept in a locked vault, and your family members must know where it is. These are important considerations as a high net worth person that you have to look at, especially when you look at estates. Private wealth management, certainly one uses the actual dashboard approach here. If one normally, as an individual, you want to do an annual medical checkup, you go to a physician, he would check your blood pressure, your blood sugar, your cholesterol, and your ECG, and if everything is in order, he will give you a clean bill of health. But I may ask you, how many of you go for a financial checkup to check whether your risk cover, both for yourself and your family, has been put in place? In other words, life, disability, trauma, and all the relevant covers that apply, that your wealth creation, your retirement has also been structured in a way that you would be comfortably be able to retire, that your tax affairs are up to date, your inter vivos trust that you perhaps have, that you are administering it well, and that your will is in place. Now, many of you decide to go for the medical checkup annually, but forget about doing the financial checkup, and that's very important. So hence, the dashboard approach is important. Certainly, from an investment perspective, we find that here we have a line drawn in the middle, and on the one side you have security, and the other side you have growth. So if you're a high net worth individual on your 45 cents tax bracket, if you invest money in the bank, which is regarded as savings and fixed deposits, your growth is small after tax because now you'd get a 5% return less 45% tax. You'll probably get a return of 2.7%, but your security is great. But on the other hand, if you decide to invest on the stock market, especially now, you'd find that your growth potential is great, but your security is small. So where should you be investing? In the middle here somewhere? No. When you are young, you have the appetite to take on risk, and you must be quite happy to invest in things like shares and risk capital and unit trusts and so on, and allow that money to grow over a period of time for you, so that when you reach closer to retirement, that you convert all that growth money into savings and fixed deposits, and you'd be able to then comfortably live with that. Many people don't consider this principle when they look at their investments. Now let's listen.
You're just too good to be true. Can't take my eyes off of you. You'd be like heaven to touch. I wanna hold you so much. At long last, love has arrived. I thank God I'm alive. You're just too good to be true. Can't take my eyes off of you. Pardon